Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is your weekly index review for March 8th, 2024. Starting off with a weekly chart of the S&P 500, you can see on the chart the S&P 500 was down just over a quarter percent for the week. Volume on the downside was the heaviest weekly downside volume we've seen since the start of this uptrend in October 2023. And volume tends to occur at major turning points in the stock market. We'll definitely review that when we look at the semiconductors in the sector review. But overall, as I've written in the correction playbook and in other documents, it's typical to see volume at these major turning points. When this uptrend started, we saw heavy volume to the upside coming out of the initial week higher. And then now we're finally seeing some major selling pressure. This is also the most bearish candlestick on the weekly chart of this entire uptrend now, with a doji reversal. And we'll see if the bears can put more selling pressure on this market heading into next week. And looking at the daily chart, you can see early in the week, the market sold off on heavy volume. This was on Monday and Tuesday. Wednesday and Thursday, there was a rally. And then Friday, we sold off, kind of reversed off the highs of the day on heavy volume. A lot of this was attributed to what happened with NVIDIA on Friday. There was a major reversal. Big selling volume came into NVIDIA and across multiple semiconductor stocks. And we'll look at that in the sector review as well. Looking at this S&P 500 from a long-term perspective, this is a really critical chart to go back and look at how stretched the S&P 500 has been above the 30-week moving average and what has happened after that. We're coming off a point right now where we've gotten to about 10% stretched above the 30-week moving average for the S&P 500. This is a pretty rare level after a major advance to see, the S&P 500 stretched this far above that key moving average. And if you go back and look at different periods over the last 20 years where this has occurred, major corrections have followed almost all of these cases. If you look at what happened in 2009, there was multiple corrections after the S&P 500 was stretched above, or more than 10% stretched above the 30-week moving average. In 2011, there was a 10% correction after getting about 10% stretched above the 30-week moving average. Again, in 2013, this correction was about 7% during a powerful uptrend in 2013, but it was still the biggest correction in 2013 occurred after the S&P 500 was very stretched above the 30-week moving average. In early 2018, after a major advance during 2017, the stock market had a very nasty more than 10% correction after getting more than 10% stretched above this key moving average. In 2020, there was two 10% corrections in September and October 2020 after being more than 10% stretched above the 30-week moving average. And finally, the only case where the market avoided a significant correction really was in 2021, where the market remained above the key moving average and got pretty stretched, but the large cap, mega cap tech stocks really are what finished off this uptrend. And then the S&P 500 eventually made a major top, in late 2021, which resulted in the 2022 bear market. So in all these cases, except for 2021, the market had significant corrections after getting this stretched above the 30-week moving average. So the market, to summarize, is extremely vulnerable here. And I think there's good chance that there's going to be a big pullback after this rally. And it could even be up to a 10% correction, which would actually wipe out all the gains for the S&P 500, as the S&P 500 is up about 7.6% for the year right now. Now, moving to the large cap technology stocks, the triple Q was down about 1.5% this week. You can see how volume again here was above average weekly sell volume. This is the biggest sell volume since the correction out of the October 2023 low started. And we're also getting closer and closer to underperforming the S&P 500 now. After the last 2 weeks, tech did rally, but overall, tech has actually deteriorated against the S&P 500 all year. Um, and that's a big change from what happened coming out of the bear market lows. Tech really exploded on the scene and really brought this market out of a bear market. And now the reverse is occurring, where large cap tech is continuing to weaken, and really Nvidia is what has propped this entire market up. Moving to the daily chart, there was massive sell volume in large cap tech this week. This is the biggest daily downside volume in 2024 and the biggest daily downside volume since the correction in October 2023 ended. So bears came back into the market very strongly on Friday. A key thing to watch next week is to see if we get a break below the 20-day moving average. That would be the first, or I guess we got a break of that briefly in early this year. But if we do break this moving average again, that starts to break the trend and increases the odds that we could be moving into the first correction of the year. The NASDAQ was down on heavy volume, weekly volume this week. Again, just like the other indexes, biggest weekly downside volume since the correction was over. Same thing with the Dow Jones Industrials, same big selling pressure to the downside. And the small caps, while they did move higher this week, volume was on the lower side. This is also kind of another doji candlestick with a big wick, indicating the bears were trying to exert pressure on this market for the week. So overall, index action very bearish this week. The most bearish action we've seen in 2024, and increasing the odds that we could be heading into a correction. The VIX simultaneously closed above the 30-week moving average this week. This is the first time this has happened since the correction was over. And the VIX has really been testing a breakout all year and just has not been able to break out because the market has remained in an uptrend, really powered by this semiconductor move higher. Finally, looking at breadth is actually overbought once again. Breadth has improved over the last 3 weeks, which has allowed the stock market to continue higher. However, when breadth is overbought, that makes the market more vulnerable to a correction. So another piece of the puzzle that would increase the odds of a correction occurring is, having most stocks overbought. So overall, this market is probably at its most dangerous point of the year. And I think the action in leading into Nvidia next week is really going to determine if the correction is starting imminently or whether we have just a little bit more time left before we finally get into that correction for the first time this year.